Alright, I'll see you. Hey, what's going on, everyone? I'm Anthony.
And I'm Samantha.
We're both realtors here in California, where we've helped people from all over the state buy and sell property.
In this video, we will be talking about deferring capital gains tax on the sale of an investment property using what is known as a 1031 exchange.
1031 exchange refers to Section 1031 of the IRS tax code, which allows investors to sell their investment properties and use all of the proceeds to buy a replacement investment property and defer taxes along the way.
In order to qualify, the property used in the exchange must be an investment property and not your personal residence. The property that it is being exchanged for must also be used for investment purposes only.
This is usually referred to as exchanging like-kind property, but that doesn't mean that you need to trade a house for a house, or you can only trade apartments for apartments. Like-kind just means that both properties need to be used solely for investment purposes.
So you can exchange a house for an apartment or land for an apartment. The point is, both of these properties have to be used for investment purposes only.
And besides being able to defer taxes and switch investment property types, a 1031 exchange can also help you diversify or consolidate your real estate portfolio.
For example, if you have 5 investment properties that you're having trouble managing, you can exchange for, let's say, 1 or 2 bigger properties that will give you the same return but with significantly less work.
The opposite is also true. If you have one big property, you can exchange it for multiple smaller properties that maybe collectively give you a better return than your one big property did.
It can also potentially increase your purchasing power. If you're presented with an incredible investment opportunity and you don't have enough funds to go through with a normal sale, you can use your investment property to go through with that sale.
1031 exchanges are also a great way to build generational wealth for your future heirs. If they inherit exchange property and sell the moment they fully acquire it, they won't have to pay capital gains taxes either.
To give you guys an example of how much you can save, let's assume you have a property worth $1 million with no debt.
Let's also assume the property is fully depreciated and you have $100,000 invested in it as your basis.
If you sell the property for the $1 million it is worth, you have a gain of $900,000. With federal capital gains tax, depreciation recapture tax, net investment income tax, and in some places a state tax, you can assume a combined tax rate of at least 25%.
That is $225,000 of the $900,000 gained from the sale that you would lose to taxes. So in reality, you only end up with $675,000 to reinvest. But with a 1031 exchange, you would be able to use all $900,000 to reinvest.
Clearly, this is a very powerful investment tool if used correctly, which is why we're making this video, so that any investor out there can take full advantage of any investment property they are thinking of selling.
Now, the way the 1031 exchange process works is a little different from the way you would normally sell a property.
The first few steps are the same. You would meet with a realtor like us to determine the value of your home and how quickly it would sell in the current market.
Time is of the essence in a 1031 exchange, so you want to make sure that your investment property sells as quickly as possible, and also that you have enough equity in it to be able to purchase the replacement property with.
Any investor looking to exchange a property will also need to work with an intermediary.
Most realtors, like us, already know some intermediaries that provide excellent services. So if you don't know who to go to, ask your realtor first.
To begin, you will list your property or properties if selling multiple up for sale at the same time.
Up to this point, the selling process should be the same as any other sale. You will work with a realtor to get the best possible price for your investment property and do what you can to ensure a smooth transaction.
Things change the moment one of your properties sells. At this point, you enter into an agreement with a qualified intermediary, relinquishing your rights in the sale contract to them.
This way, when the sale fully closes, the intermediary will receive the funds from the sale and the buyer will receive the deed to the investment property. This ensures that you don't touch any of the proceeds.
This is very important. The IRS will only accept a 1031 tax deferral if you can prove all of the funds from the sale of an investment property were used solely for the exchange.
If it is ever proven that any of the money touched any of your personal accounts, the deferral would be void because it would automatically be considered income and therefore subject to tax.
As soon as one of your properties closes, you have 45 days to identify a replacement and 180 days total to close on the sale of your final replacement property.
This is why time is of the essence in a 1031 exchange. If your first property sells quickly, within a week, but the second or third properties take way longer and you can't sell them and much less find a replacement property for them within the 45 days, then the deferral will only apply to that first house that sold quickly.
In this scenario, you will be left with a smaller budget to exchange with, and at least one of your properties will be sold and subject to capital gains tax.
This is why it is crucial to work with a realtor that you can trust will help you meet the necessary deadlines.
Once you've identified all of the replacement properties within the given 45-day window, you will have the remaining of the 180 days to finalize on the purchase of the properties.
When signing the purchase contract for the replacement property, you will assign your rights in the purchase to the intermediary.
Before escrow closes, your intermediary will wire the funds they have been holding directly to the seller of your replacement property. They will then instruct the settlement officer to transfer the deed directly to you.
This will finalize the transaction and you will have successfully exchanged your properties while deferring taxes.
It is also important that you are exchanging for a property of equal or greater value and that you reinvest all of the equity available.
If there's any money left over, meaning the proceeds from the sales of your investment properties gave you more than the replacement property's cost, then you will be taxed accordingly to the leftovers, or the boot as they call it.
So make sure that you use all of the money that you get if you want this to work correctly.
But that's pretty much it, guys. If you have any questions, please comment below.
Or if you would like to work with us, please reach out. We will leave our contact info in the description below.
We only work within California and primarily specialize within the Bay Area, but we've helped folks as far down as Riverside, so please don't hesitate to ask us anything.
And like we've said before, we work full-time as realtors, so if you like these videos, please like and subscribe so we know to devote more time to this.
And we hope to get the chance to work with some of you guys and help you achieve your real estate goals. But until then, see you guys in the next video.